Special cases. Principal versus agent. If entity is acting as an principal, then recognize revenue on gross basis. If entity is acting as an agent, then recognize revenue on net basis. That means only commission or fees to which it is entitled should be recognized. What are the indicators that an entity is a principal? There are three indicators that shows that entity is a principal. The entity is primarily responsible for fulfilling the contract, and the entity has inventory risk before goods or services has been transferred to the customer, and the entity has discretion in establishing prices for goods or services. In some contracts in which the entity is the agent, control of goods or services promised by the agent might transfer before the customer receives the goods or services from the principal. That means if the entity is an agent, goods or services control might be transferred before the delivery of goods or services to the customer. In such a case, it is treated as entities acting as an agent and recognize revenue on net basis. That means only commission or fees which it is entitled should be recognized as revenue. Next, non-refundable upfront fees. If non-refundable upfront fees relates to goods or services which entity has to provide and it is a separate performance obligation, in such a case, recognize revenue on transfer of promised goods or services. In case non-refundable upfront fees does not relate to goods or services to be provided or is not a separate performance obligation, then account for as an advanced payment for future goods and recognize revenue over the period when performance obligation is satisfied. Example of non-refundable upfront fees is joining fees in health club membership, activation fees for telecom services, setup fees in service contracts, etc. These are examples of non-refundable upfront fees. Next, customer options for additional goods or services. In case an entity gives customer option to purchase additional goods or services by way of coupons, gift cards, and customer award credits like loyalty or reward programs, etc., then such option is treated as separate performance obligation only if it provides a material right to the customer that the customer would not receive without entering into the contract. Example, a discount that exceeds the range of discounts typically given for those goods or services to that class of customer in that geographical area or market. If the option provides a material right to the customer, the entity recognizes revenue when those future goods or services are transferred or when the option expires. The entity has to allocate the transaction price to performance obligations on a relative standalone selling price basis. If standalone selling price of the additional goods or services is not directly observable, an entity shall estimate it. That estimate shall reflect the discount that the customer would obtain when exercising the option, adjusting for both the following: any discount that the customer could receive without exercising the option, and the likelihood, that means probability, that the option will be exercised. So in case of a customer option to purchase additional goods or services, it will be treated as separate performance obligation, provided it provides a material right to the customer that the customer would not receive without entering into the contract. That means customer should mandatorily enter into the contract to avail the benefit. In such a case, the revenue will be recognized in case of goods or services are transferred or when the option expires. In any of the cases, revenue will be recognized. Next, sale with right of return. To account for transfer of products with a right of return and for some services that are provided subject to a refund, an entity shall recognize revenue for the transferred products only to the extent entity expects to be entitled. That is, therefore, revenue would not be recognized for the products expected to be returned. That means revenue is recognized only to the extent that products expected to be not returned. And also recognize a refund liability for consideration received on goods expected to be returned by the customer. And recognize an asset and a corresponding adjustment to cost of sales, that is P&L, for its right to recover products from the customer. Asset will be recognized at a carrying amount of the product less any expected cost to recover those products less potential decreases in the value of returned products. The entity shall present the asset separately from the refund liability. Exchanges by customers of one product for another of the same type, quality, condition, and price. For example, one color or size for another are not considered as returns as per Ind AS 115. So exchange will not be considered as a return. That means recognize revenue only for the products which are not expected to be returned, and recognize refund liability for consideration received on goods expected to be returned by the customer, and recognize an asset for its right to recover products from the customers. Next, accounting for restocking fees for the goods that are expected to be returned. Entities sometimes charge customers a restocking fees when a product is returned. These fees may be levied by entities to compensate them for the cost of repackaging, shipping, and are reselling the item at a lower price to another customer. Restocking fees for goods that are expected to be returned would be included in the estimation of a transaction price at contract inception and it will be recorded as revenue when the control of goods transferred. Example, an entity enters into a contract with a customer to sell 10 units of product for rupees 100 per unit. The customer has the right to return the product, but if it does so, it will be charged a 3% restocking fees, that is R3 per return unit, or rupees 3 per return unit. The entity estimates that 10% of the sold units will be returned. Upon transfer of control of 10 units, the entity will recognize revenue of 903. How 903? 9 units which are not expected to be returned into 100, that is 100 is the selling price, plus 1 unit expected to be returned into 3 restocking fees per unit. A refund liability of 97 will also be recorded. How 97? 1 unit expected to be returned into 100 selling price minus 3 restocking fees. So rupees 97 will be recorded as refund liability, and rupees 903 will be recognized as a revenue. That means restocking fees will be recognized as revenue when control is transferred. Next, warranties. In case of warranties, if customer has an option to purchase warranties separately, example service type warranties, in this case warranty will be distinct service and should be accounted as a separate performance obligation, and a portion of transaction price should be allocated to it. In case if customer does not have the option to purchase warranty separately, example assurance type warranties, in this case warranty should not be considered as separate performance obligation and the entire revenue should be attributable to the product. However, provision for warranty should be created as per Ind AS 37. In assessing whether a warranty is a separate performance obligation or not, an entity shall consider factors such as whether the warranty is required by law. If it is required by law, it indicates that the promised warranty is not a performance obligation. Next, length of warranty coverage period. Longer the coverage period, the more likely it is that the promised warranty is a separate performance obligation. Next, consignment arrangements. A consignment arrangement is an agreement between the consignee and the consignor for the storage, transfer, sale or resale and use of goods. Entities, that is the consignor, frequently deliver inventory on a consignment basis to other parties like distributor, dealers who are consignees. What are the indicators to evaluate whether the arrangement is a consignment arrangement? Indicators for treating it as consignment arrangement. The product is controlled by the entity, that is the consignor, until a specified event occurs, such as sale of the product to a customer of the dealer or until a specified period expires, and the entity, that is the consignor, is able to require the return of the product or transfer the product to a third party, such as another dealer, and the dealer, that is the consignee, does not have an unconditional obligation to pay for the product until the goods or services to the ultimate or end consumer. Goods or services are sold to the ultimate or end consumer, although it might be required to pay a deposit. In case of consignment arrangements, revenue would not be recognized when the goods are delivered to the consignee because control has not yet transferred. That means revenue is recognized when the entity has transferred the control of the goods to the consignor or the end consumer. A consignment sale differs from a sale with a right of return. The customer has control of the goods in a sale with a right of return and can decide whether to put the goods back to the seller. In case of consignment sales, the consignee does not have the control over the goods. So revenue is recognized only when transfer of control of the goods has been done to the consignor or the end consumer. Next, sale and repurchase agreements. A repurchase agreement is a contract in which an entity sells goods and also promises or has the option to repurchase the goods. In case of repurchase agreements, revenue should not be recognized as the customer does not obtain control, even though the customer may have physical possession of the asset. Consequently, the entity shall account for the contract as either of the following. In case of repurchase agreements, if repurchase price is more than or equal to original selling price. Here repurchase price is 11 lakhs and original selling price is 10 lakhs. Here that means repurchase price is greater than original selling price, then it will be considered as financing arrangement. As per Ind AS 109, that is recognize the consideration received, that is 10 lakhs as financial liability. Also recognize the difference between original selling price 10 lakhs and repurchase price 11 lakhs as finance cost over the period. If repurchase price is less than original selling price, here repurchase price is 9 lakhs and original selling price is 10 lakhs. It will be considered as lease contract as per Ind AS 116, in which the difference between original selling price 10 lakhs and repurchase price 9 lakhs shall be recognized as lease income over a period of lease. Next, if the option lapses unexercised, an entity shall de-recognize the liability and recognize the revenue. That means if the option lapses, then de-recognize the liability and recognize the revenue. The above treatment would be done for options only if the entity estimates at the inception that there is a significant economic incentive for the option holder to exercise the option. If the customer does not have a significant economic incentive to exercise its rights, the entity shall account for the agreement as a sale of a product with a right of return. That means if the customer has significant economic incentive, then it will be treated as option. Option accounting will be done. If the customer does not have a significant economic incentive, then it will be accounted as agreement as sale. So it will be considered as sale. In case customer does not have significant economic incentive to exercise its rights. Next, bill and hold. Bill and hold arrangement is a contract under which an entity bills a customer for a product, but the entity retains the physical possession of the product at the customer's request because of customer's lack of available space or because of delays in the customer's production schedules. In such arrangements, the entity shall recognize revenue at a point in time when control is transferred to the customer. For a customer to have obtained control of a product, even though the product remains in an entity's physical possession, that is bill and hold arrangement, all the following criteria must be met. The reason for bill and hold arrangement must be substantive. For example, the customer has requested the arrangement and the product must be identified separately as belonging to the customer, and the product currently must be ready for physical transfer to the customer, and the entity cannot have the ability to use the product or to direct it to another customer. If all the conditions are satisfied, it will be considered as bill and hold arrangement and revenue is recognized at a point in time. Where an entity recognizes revenue on bill and hold basis, the entity checks for additional performance obligations, for example, custodial services for goods held, and allocate a portion of transaction price to each performance obligation. Next, license of intellectual property. Recognition of revenue for license of intellectual property, example, software and technology, media and entertainment, example, motion pictures and music, franchises, patents, trademark and copyrights, differs from the recognition model for other promised goods or services. A license will either provide A right to access the entity's intellectual property throughout the license period, which results in a revenue that is recognized over time, or a right to use the entity's intellectual property as it exists at the point in time in which the license is granted, which results in revenue that is recognized at a point in time. A right to access intellectual property over a time, over a period of time. In order to say that there is a right to access intellectual property over time, all conditions must be met. First one, the entity is required by the contract are reasonably expected by the customer to undertake activities that significantly affect the licensed intellectual property. The license exposes the customers to any effects of the entity's activities, and the entity's activities are not a performance obligation under the contract. In such a case, if all the conditions are satisfied, then it is said that a right to access intellectual property is there for over a period of time, and recognize revenue over a period of time. For example, Pogo has created a popular television show called Chota Bheem. Pogo grants a 3-year license to toy manufacturer for use of the character Chota Bheem on its toys. As per the contract, Pogo will continue to produce the show, popularize the character, carry out marketing activities. The toy manufacturers produces and sells Chota Bheem toys. In this case, the license provides access to Pogo's intellectual property (IP). Pogo will undertake activities that significantly affect the intellectual property by production and marketing of the show, development of the characters. Toy manufacturer is directly exposed to any positive or negative effects by Pogo activities. That is how the show is received by kids and their parents. These activities are not separate performance obligations as they do not transfer a goods or services to toy manufacturer that is separate from the license. Hence, Pogo will recognize revenue over a period of time. Next, right to use. If all the three criteria for access over time are not met, the nature of the entity's promise is to provide a right to use the intellectual property as it exists at a specific point in time. The customer gains control over that intellectual property at the beginning of the period for which it has the right to use intellectual property. In case if any of the three criteria are not met, then recognize revenue at a point in time. If three criteria met, recognize revenue over a period of time. Otherwise, recognize revenue at a point in time. Next, contract costs. Contract costs are of two types: contract acquisition cost, contract fulfillment cost. Contract acquisition cost includes cost incurred whether or not contract is obtained or not. It will be recognized as expense and transferred to P&L account. Incremental cost. Contract acquisition cost also includes incremental cost to obtain a contract that would not be incurred if the contract not obtained. Then it will be recognized as asset, that means capitalized, if the entity expects to recover it. If the amortization period of the asset is less than equals to 1 year, then the entity may expense out such incremental cost. That means in case of short term, it will be transferred to P&L account, otherwise it will be capitalized. Next, contract fulfillment cost. It includes cost incurred in fulfilling a contract are covered under another standard, that is as per Ind AS 2 or Ind AS 16. If the costs are covered under as per other standards, then the entity shall account for such cost in accordance with those standards, either Ind AS 2 or Ind AS 16. If costs are not covered under other Ind AS, then entity shall recognize an asset for such cost provided all conditions are met. First condition, cost directly relates to a contract, such as direct material, direct labor, other indirect cost of production, and cost generates or enhances the resources of entity that will be used to satisfy performance obligation in the future, and the entity expects to recover the cost. For example, through the expected margin. If all the conditions are satisfied, then recognize the revenue for such costs. Next, the following contract fulfillment cost should be expensed as incurred. That means it will be transferred to P&L account. It will not be capitalized. First one, general and administration cost that are not explicitly chargeable to the customer. It will be charged to P&L account. Cost of wasted materials, labors, or other resources that were not reflected in the contract price. It will be charged to P&L account. Cost that relates to satisfied performance obligations. It will be charged to profit and loss account. They will not be capitalized. They will be charged to profit and loss account as expense. Next, examples of contract acquisition costs. First one, commission paid only upon successful signing of the contract. We need to capitalize the expense. Assuming that entity expects to recover the cost, the commission is incremental since it would not have been paid if the parties decided not to enter into the arrangement just before signing. Second, travel expenses for salespersons pitching a new client contract. It will be treated as expense and will be charged to P&L account because the costs are incurred regardless of whether the new contract is won or lost. The entity expends the cost unless they are expressly reimbursable. So it will be charged to P&L account. Next, legal fees for drafting terms of arrangement for parties to approve and sign. It will be charged to P&L account as expense. If the parties walk away during negotiations, the cost would still be incurred and therefore are not incremental cost of obtaining the contract. So it will be charged to P&L account as an expense. Next, salaries for salespeople working exclusively on obtaining new clients. It will be charged to P&L account as an expense. The salaries are incurred regardless of whether contracts are won or lost and therefore are not incremental cost to obtain the contract. Next, bonus based on quarterly sales targets. It will be capitalized because bonuses based on solely on sales are incremental cost, and these incremental costs are incurred to obtain a contract, so they need to be capitalized. Next, commission paid to sales manager based on contracts obtained by the sales manager's local employees. It need to be capitalized as the commissions are incremental cost that would not have been incurred had the entity not obtained the contract. Ind AS 115 does not differentiate cost based on a function or title of the employee that receives the commission. So that cost need to be capitalized. Next, amortization and impairment of contract cost recognized as an asset. Amortize capitalized contract cost on a systematic basis consistent with the pattern of transferring goods or services. Recognize an impairment loss in earnings if carrying amount of an asset exceeds remaining amount of the consideration less directly related contract cost yet to be recognized. Before recognizing an impairment loss under the revenue recognition guidance, an entity recognizes impairment loss associated with assets related to Ind AS 2, Ind AS 16 and Ind AS 38. Reversal of impairment loss is permitted, which is same as Ind AS 36. That means before recognizing the revenue loss as per Ind AS 115, first recognize the before recognizing the impairment loss as per Ind AS 115, first recognize the impairment loss as per Ind AS 2, 16 and 38. And if any reversal of impairment loss is there, it will be permitted as per Ind AS 36. Next, service concession arrangements. Service concession arrangements involve the construction of infrastructure used to provide public services. It also involves operating and maintaining that infrastructure for a specified period of time. It is also called as build, operate, transfer, BOT, or public to private service concession arrangement. It is of a public service nature because it has some involvement of the infrastructure which is used by the general public. It can be bridges, roads, national highways, etc. In case of service concession arrangements, there are two parties, grantor, operator. Grantor, it is a public authority, example government body, that grants the operator contract to construct or upgrade and operate that infrastructure for a specified period of time. Operator, an entity constructing and operating the infrastructure. The operator is paid for its services over the period of arrangement. Accounting principles. Treatment of operators' right over the infrastructure. Infrastructure under this arrangement shall not be recognized as PP, property, plant and equipment, by the operator. It is because operator does not have the right to control the use of the public service infrastructure, but operator has access to operate infrastructure to provide public service on behalf of the grantor in accordance with the terms specified in the contract. Recognition measurement. Operator who is acting as a service provider shall recognize revenue as per Ind AS 115 if the operator is performing more than one service, that is contract services construction services and operating services under a single contract, the consideration received or receivable shall be allocated based on fair value of the services provided. That means allocation will be done on the basis of fair value of services provided. Consideration given by grantor to the operator. The grantor can provide the operator with the consideration which shall be recognized at fair value. That means recognize consideration at fair value. Next, consideration by grantor to operator. If there is an unconditional right to receive cash or another financial asset from grantor for constructing a public sector asset and then operating it for a specified period, recognize the right to financial asset, account the financial asset under Ind AS 109 as per amortized cost method or FET-OCI, FETPL, and recognize the finance income in case of amortized cost method and FET-OCI based on EIR, effective interest rate. In case of right to charge users of public service, a right to charge users is not an unconditional right to receive cash because amounts are contingent on the extent to which the public uses the service. In such a case, recognize a right to an intangible asset. Apply Ind AS 38 for measuring intangible assets acquired in exchange and amortizing such intangible assets. So in such a case, Ind AS 38 is applicable. We need to recognize the right to an intangible asset. If the operator is paid for construction services partly by a financial asset and partly by an intangible asset, it is necessary to account separately for each component of the operator's consideration. That means if consideration includes financial asset and intangible asset, then we need to separately account for each component as per this standard.